Good morning, dear students. Today we will be studying the last part in the second unit of income tax, that is house property. As we know, house property is the very important source of income, and it is one of the important head of income tax. As there are five heads, which are like income from salary, income from business and profession, income from house property, capital gains, and other sources. Out of it, house property is also one of the most important head of income, which is being considered while calculating the total income of a person. A house property could be your home, an office, a shop, building, or some land attached to building like parking lot. The Income Tax Act does not differentiate between a commercial and residential property. All types of properties are taxed under the head income from house property in the income tax return. An owner, for this purpose, he should be a legal owner, and he has a right to consider that particular income on his name. When a property is used for the purpose of business or a profession or for carrying out freelancing work, it is taxed under the head income from business and profession head. Expenses on its repairs and maintenance are allowed as business expenditures. But apart from that, if you have given land, building, or any other property for rent and you are getting a rent out of it, that particular rent monthly income what you get, it should be taxed under the head income from house property. Self-occupied house property. A self-occupied house property is used for one's own residential purpose. This may be occupied by the taxpayer's family, parents, and the spouse and children. A vacant house property is considered as self-occupied for the purpose of income tax. While the owner, he himself, is staying with his family members, his wife, children, his parents, with them they are staying in that particular house, and that particular house is treated as self-occupied property, SOP. Prior to financial year 1920, means before 1920, if more than one self-occupied house property is owned by the taxpayer, only one is considered and treated as self-occupied property. Right? Suppose if he is having two self-occupied property, in that case, before 1920, it was treated that only one house will be treated as the self-occupied SOP property, and the remaining are assumed to be let out. The choice of which property to be choose as self-occupied is up to the taxpayer, but the taxpayer has to decide which particular property is self-occupied property and which he is going to treat as LOP, let out property. Now, for the assessment year 1920 onwards, the benefits of considering the houses as self-occupied has been extended to two houses. Now you can make two houses as SOP, self-occupied property. Homeowner can claim two properties as self-occupied and remaining house as let-out property. If he is having 5 houses, earlier days one house was treated as SOP and remaining all houses were treated as LOP, let-out property. But right now, means after 1920 financial year, it will be treated that two houses of the person will be treated as self-occupied property, right? And remaining more than 2 houses, whatever he is having, it will be treated as let-out property. Now, let-out house property. A house property which is rented for the whole or part of the year is considered a let-out house property for income tax purpose, right? The property which you are giving on rent basis and you are getting a rent out of it, whether you are getting rent for the whole year for 12 months or you are getting a rent for only the part of some year, so that will be treated as let out property while calculating your income tax. Inherited property. An inherited property, on this is that property which is passed or benefited from the parents and other people, and this is like ancestors property which is gone or passed by their parents, grandparents, and then from parents, right? then to children's. So these kind of properties are inherited property, and this is also treated as self-occupied property or let out property in some cases if you are giving that property on rent basis. Now, how to calculate the income from house property? For our syllabus, only theoretical part is there for house property, but we need to know the theory. Only how do we calculate the house property? First of all, you need to determine the gross annual value. The gross annual value will be calculated first. After that, you have to reduce the property tax in that gross annual value. Once you reduce property tax, you will determine net annual value. So net annual value equal to gross annual value minus property tax. Then reduce 30% of net annual value towards standard deduction. So as per section 24, 30% of the net annual value has to be reduced as the standard deduction. Once you reduce that standard deduction, then reduce home loan interest. If you have taken any home loan, that interest on the home loan has to be reduced. Then determine the income from house property. You will determine the income from house property, and if any loss on house property is there, like when you own a self-occupied house, since it is gross annual value is nil, and claiming the deduction of home loan interest will result as loss. You cannot claim here as a loss. Such loss will be adjusted against the income from other heads or income from other house properties.